The U.S. stock market indices have ripped higher so far in 2023, with major investor favorites like Apple and Microsoft both up over 40%. Tesla stock over 100% higher so far this year. Where do we go from here? In this video, I'm going to explore the perspectives from some of the greatest investors, including Stanley Druckenmiller, Ray Dalio, and Warren Buffett, to understand how they're positioning themselves recently, maybe their perspective on the macro economy. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make a point of hitting that thumbs up, hit that subscribe button. Let's dive in right now to understand Ray Dalio's perspective on where we are. He says we haven't even seen the consequences yet, really, with regard to the Federal Reserve tightening, with significant hike in interest rates from around 0 to 5.25% currently. And what he's really referring to is how there's a lag with monetary tightening. Oftentimes it's somewhere between 6 months to 24 months before you really start feeling the impact. A lot of investors are focused on, hey, what's the latest lagging indicator like unemployment? But the reality is you need to be focusing on the leading indicators, which are showing generally an economy that is contracting or facing significant pressure. So he's saying, look, focus on, where we're heading versus where we've been. We haven't seen the consequences from the significant monetary tightening because there's typically a significant lag effect that we haven't yet experienced with asset prices and the U.S. economy. You see Stanley Druckenmiller, he's saying we are on the brink of a hard landing in the U.S., claiming that the Fed has basically wasted all our bullets. In case you're wondering if you should even consider Stanley Druckenmiller, a very successful trader, over his career, he generated over a 30% annualized return for 30 years with no single down year. So on a hypothetical basis, that would be the equivalent of investing $10,000 at the start, not putting in a dollar more, and then walking away with over $25 million 30 years later. So just an incredible track record for Stanley Druckenmiller, once again, without a single down year. So I like to hear what he has to say now that he's just managing his own funds. He says, look, our central case is there's more shoes to drop. He's talking about not only the asset markets, i.e. the stock market, but also the economy. So we haven't really seen the full pinch to the economy, meaning unemployment could, tick up a little bit higher. He also goes, when you go from this kind of environment, the biggest, broadest asset bubble ever, he's talking about the massive, manias that you saw post-COVID due to record stimulus, the silly, monkey pictures being sold for millions of dollars. And then you jack interest rates up 500 basis points, so 5% in a year, which this is very similar comment to Ray Dalio. I think the probability is that Silicon Valley Bank, Bed Bath & Beyond, they're probably the tip of the iceberg. So he's saying, look, the challenges you've seen, the bankruptcies you've seen, this is probably just starting. You're probably going to see an uptick in bankruptcies, and you're also probably going to see continued pressure and challenges in the banking sector. After all, with many of the mega banks offering around 0% on their deposits, and where you can get, 4% plus on your cash elsewhere, there still is that incentive to pull funds and move it elsewhere. And I'll talk more about that in just a second, what I'm personally doing with my own cash. He himself has invested, and I don't think he's gone heavily invested, but he's made a sizable bet with stocks that have benefited from artificial intelligence like NVIDIA as well as Microsoft. So he's made hundreds of millions of dollars just this year on these bets because Microsoft has done well and NVIDIA has done even better, up several 100%, because he saw the trend with AI and he said, hey, I want to lean into it. I wouldn't necessarily chase this. I did a prior video on NVIDIA. It might be getting ahead of itself. I think it is, just based on how fast it's moved. So I wouldn't necessarily chase that behavior. It's worked for him, but he's a trader. He may get in and out of it. That's Stanley Druckenmiller. Let's look at a long-term investor like Warren Buffett. Just today, he announced that Berkshire Hathaway is increasing their stake in 5 Japanese trading houses, so boosting their average investment to a little under 9%. So this is another signal like, hey, he's not buying heavily into U.S. stocks right now. He's finding value elsewhere with Japan. Now, he's able to do things that other investors cannot do because he can borrow using Berkshire Hathaway, so issue bonds in yen, the Japanese currency, and sort of offset his currency risk. So it is certainly easier for him to do this than, let's say, an everyday investor. And he's also making a broad-based bet where he's saying, I want to own things that are statistically cheap, so maybe trading at a high single digits or low teens earnings multiple, and that take their earnings and buy back stock. And so it's really a basket saying, I like this structure where if you have these low valuations, you maybe have a little bit of inflation, and you use this low valuation and your free cash flow to buy back stock, it can result in attractive returns to shareholders. So that's, I think, what he's looking at here with this basket of Japanese stocks, because it really isn't one single bet on a particular market. It's a bet on these Japanese companies, but these sub companies manage many different businesses, hundreds of different businesses. When you zoom out a bit using AI Ticker Chat, which is a artificial intelligence platform that now helps you analyze stocks. First month is free. See the link below in terms of using AI Ticker Chat. Quickly pull up Berkshire Hathaway's financials under the cash flow statement. You can see in the last quarter, Berkshire's Warren Buffett was actually a net seller of stock. He purchased a little under $3 billion of stock and he sold $13 billion worth of stock. So if that isn't yet another signal that, it's not like he's finding something super compelling in his home market, that he's looking at. You combine this with Ray Dalio and Stanley Druckenmiller, it doesn't strike me as super enticing. Okay, so where does the market potentially go from here after seeing a significant rally so far in 2023? Well, first of all, in full disclosure, this is not financial advice. I also recently bought more of a stock that I think has over 300% upside that I called out to my subscribers at unrivaledinvesting.com. I also expect to raise prices soon, so now's the time to act if you'd like to lock in a favorable rate and take charge of your investment journey. That's unrivaledinvesting.com. So taking stock of where we are right now, look at the CNN, greed index, greed fear business index. And right now it's pointing at extreme greed. Now, this is a metric that tracks momentum, but broadly as an investor indicator, you want to think when investors are fearful, that's when you buy. When investors are extremely greedy, that's when you consider taking a few chips off the table or saying, hey, I'm not going to necessarily chase right now. And so I'm looking at this and I think this is a very easy public signal to investors that a lot of folks are thinking about chasing. A lot of folks are looking at the success of NVIDIA and what Stanley Druckenmiller did and thinking about AI, and they're thinking, man, I want to participate too. And they're pushing it further and further into extreme greed. And that is not something I encourage at all. You see this further with magazine covers like Barron's talking about how this market has legs. I personally love the indicators that you get from magazine covers. For example, just recently, I think at the end of 2021, you had Time Magazine make Elon Musk Man of the Year. And there's a curse. I did a prior video on this where, typically when you have the Man of the Year award, within the next year or so, the stock gets hammered. And that's what happened with Tesla. Stock fell 50%. And oftentimes these magazine covers really do coincide near, proximate within a couple months of, peak movements or pivot movements. You saw similar movements with historic magazine covers going back to the dot-com bubble, as well as the dot-com busts, going back to 2009, the great financial crisis. Near the bottom there was a March 2009 similar cover of like, oh, this is over, blood in the streets. And then, saw a similar, equities are dead, during the previous where this bull market previously started in the 1980s. So you look at all this, and I look at magazine covers as a very interesting indicator of picking up the zeitgeist of the time, how people are feeling at the time, and potentially suggesting, okay, maybe we're getting closer to that sort of pivot point. Barron's clearly saying they're excited. I personally look at this and think, don't chase, don't go okay, I got to go put more money in NVIDIA like some of these other investors. I personally say I want to hold more cash. And so currently I'm getting, over 4.5% in interactive brokers. You can see the link below. So I'm thinking, how do I add more to my cash balances? So later this week, I'm going to call it out to my subscribers at Unrivaled Investing that I'm actually going to be easing out of some of my positions, easing up, taking a few chips off the table just to build that cash position. I do not like seeing, a period where there's a lot of extreme greed and people are reaching, and I want to look at the fundamentals. That's the whole basis of this channel. I want to look and understand, there's sizzle and there's steak. And what's actually the steak? Is it quality? What's going on here? Look at the S&P 500 and you see, wait a second. And this is from FactSet. They're talking about the estimated earnings for the S&P 500 for the second quarter is actually a decline of 6.4%. This would be the largest earnings decline reported by the index since COVID, when earnings for the S&P fell by 30%. I don't like seeing this indicator because not only do you have greed pushing things up, which is pushing valuations higher, but the underlying fundamentals are actually getting worse because you're looking at earnings really taking a toll. And this is not the first quarter that's projected to face a decline for the S&P 500. You've seen that now in the fourth quarter of last year, the first quarter of this year, now the second quarter of this year. So you see animal spirits pushing things higher at the same time that earnings are coming under pressure. I think there are a couple of key takeaways that investors should consider that I'm personally doing for my own investment journey. Number one, don't chase. So I'm looking for things that can go up 300%. If it can't meet that hurdle, then I'm not going to be, let's say, adding significantly more capital. I'm not looking to do that. I want to find things that I can comfortably say over the next, 5+ years, 300%. That's how I want to think about things that I'm going to be putting my personal capital in. So you should have a formula, have a method that you stick to when people are extremely greedy and when people are extremely fearful. I'm looking at this and I'm thinking, I don't want to chase. I want to do the opposite of what I'm seeing from a lot of folks right now in the magazine covers right now. I think the other aspect, and this is timeless, is that you want to find quality. You want to find quality businesses. You want to find quality relationships in life. But with regard to businesses, what does quality mean? So quality for me means a couple of things. One is recurring revenue. So that means even if Ray Dalio and Stanley Druckenmiller are right, and that there is this hard landing, that there's a high degree of recurring revenue. So even if there's a tough recession, these businesses will hold up. So recurring revenue is a key aspect of quality. Another aspect is balance sheet. Do they have the cash to withstand a tough period? Do they generate lots of free cash flow? So I'm looking at easing out of some or easing up some of my positions that are cash burn, that are saying, hey, you know what? If we face a recession, our cash burn could get even worse. So that's something, another aspect to quality is what's the cash flow dynamics look like. Another aspect is, are they returning the cash flow to shareholders? That's ideally what I want to see. But I'd say even more important than that is there an alignment with management? Particularly, you get that with high insider ownership. So I want to buy things, and if you look at my top holdings, you oftentimes see that where management owns a key stake in the business. And so those are the key angles from a quality business that I'm thinking about, in terms of how I want to invest right now, particularly when some of the greatest investors in the world are either taking chips off the table, Warren Buffett broadly a net seller in the first quarter, despite his increased Japan bet. And you have Ray Dalio and Druckenmiller saying, yeah, hard landing, we haven't really felt the consequences. So I hope this video has been helpful for you, saying don't chase, stick to a rational process to find quality investments. And if you enjoyed it, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in to Unrivaled Investing.